Here's a number that should stop you in your tracks. ETF flows just went negative for one of the rarest weeks in recent memory. We're talking about a market mechanism that has, for the better part of the past 2 years, absorbed cash like a sponge, week after week, through recession scares, geopolitical shocks, and rate uncertainty. And yet, as of the week ending July 13, 2026, that streak snapped. Outflows from exchange-traded funds across the board flipped the narrative entirely. Now, a single down week doesn't make a crisis, but when a vehicle as broadly trusted as the modern ETF sees net redemptions, it demands an explanation. So today, we're going to give you one. We'll look at what triggered this reversal, which corners of the market felt it most, and crucially, what it tells us about where investor sentiment actually stands right now, on Tuesday, July 14, 2026. Before we dig into the reversal, it's worth understanding why this is so unusual in the first place. ETFs have become the dominant vehicle for passive investing globally. Unlike actively managed funds, they track indices, sectors, or commodities, and they're structured in a way that makes creation and redemption of shares relatively frictionless. That mechanism usually keeps flows positive because retail and institutional investors alike treat ETFs as their default entry point into any market exposure they want. Even during volatile stretches, the Bitcoin slump of February 2026, for instance, or the semiconductor repricing earlier in the year, ETF flows held up. Investors may have rotated between themes, but the total pool of capital kept growing. The fact that this week saw a net reversal means something different is happening. It means money didn't just rotate, it actually left. That distinction is critical. So what broke the streak? Several factors converged simultaneously, and it's the combination rather than any single event that drove the outflows. First, profit-taking pressure. Markets have had a strong run through much of 2026, and with a number of thematic ETFs, particularly those tied to memory chips and DRAM, having delivered outsized gains since late 2025, a cohort of investors simply decided to lock in returns. The memory ETF trade was one of the most discussed bottleneck plays of the year. DRAM-focused funds attracted enormous attention in April and May, but by mid-July, early entrants were sitting on substantial gains. When momentum begins to stall in a thematic trade, redemptions tend to come quickly. Second, anticipation around the SpaceX IPO continued to reshape capital allocation decisions. With the prospect of a direct SpaceX listing potentially triggering a fresh wave of ETF construction, funds that would hold SpaceX equity once listed, some investors chose to reduce existing positions to maintain liquidity and optionality. Third, broader risk-off sentiment crept into the market towards the end of last week, with macro data prompting a reassessment of near-term growth expectations. Not all ETF categories suffered equally. The red ink was concentrated in a few specific areas. Thematic and sector-specific ETFs, particularly those tied to technology hardware, memory, and digital assets, bore the brunt of the outflows. Bitcoin ETFs, which had been a flashpoint of innovation in late 2025 and early 2026, saw some redemption pressure as well. The volatility-linked Bitcoin ETF products that launched earlier in 2026 are still relatively new instruments, and they tend to see sharper swings in flows as investor conviction fluctuates. Meanwhile, broad market equity ETFs, your FTSE 100 trackers, your S&P 500 funds, held up considerably better. Fixed income ETF flows were mixed, with short-duration products attracting some safe haven demand even as longer-duration bond ETFs saw modest selling. The takeaway here is clear: this was not a broad-based flight from ETFs as a structure. It was a targeted, theme-specific correction driven by sector rotation and profit realization. There's a longer-term structural trend that also provides important context here. Since at least May 2026, data has shown that investors are increasingly hungry to access private markets through ETF wrappers. This isn't just curiosity, it represents a genuine shift in how retail and institutional capital wants to operate. The TMX Group's deal to acquire RAFI indices from research affiliates, completed in June 2026, is emblematic of this broader reconfiguration of the index and ETF industry. Index providers are repositioning themselves, anticipating a world where ETFs aren't just equity and bond wrappers but gateways to private credit, infrastructure, and pre-IPO equity. What this means for flows is nuanced. As capital reallocates towards these newer, more complex ETF structures, it can temporarily suppress inflows into traditional products. Investors aren't abandoning ETFs, they're demanding a more sophisticated version of them. That transition creates friction, and friction can show up in the flow data as apparent outflows. If you hold ETFs in your ISA, your pension, or your general investment account, what does a rare negative flow week actually mean for you practically? The honest answer is, probably very little in isolation. A single week of net outflows does not invalidate the structural case for low-cost passive investing. It does not signal an impending market crash. What it does tell you is that the investor crowd has become slightly more cautious about specific high-conviction thematic bets. If you've been riding the memory chip trade or you're heavily exposed to speculative digital asset ETFs, this is a reasonable moment to reassess your position sizing. It's also a useful prompt to check whether your ETF exposure is genuinely diversified or whether, without realizing it, you've accumulated overlapping exposure to the same underlying themes through different fund wrappers, a common trap when thematic ETFs become popular. Diversification across asset classes, geographies, and market caps remains your best insulation against weeks like this one. The historical record on rare negative ETF flow weeks is instructive. In virtually every previous instance over the past decade, negative flow weeks have been followed by a recovery, sometimes immediately the following week, sometimes after a short pause of 2 to 3 weeks. The structural drivers of ETF adoption have not changed, they remain low-cost, tax-efficient, liquid, and transparent. What changes week to week is sentiment and positioning, not fundamentals. Looking ahead from today, July 14, 2026, the most likely catalyst for a flows rebound is fresh thematic clarity. The SpaceX IPO narrative, if it crystallizes into a confirmed launch timeline, would likely trigger significant new ETF construction and subsequent investor demand for those new products. Bitcoin ETF flows are also highly sensitive to price momentum. A sustained recovery in crypto prices would almost certainly pull capital back in. On the traditional equity side, any positive macro surprise on growth or earnings would stabilize the environment. The balance of probabilities points to this week in the red being an anomaly rather than the start of a trend. Step back from the noise for a moment, and this week's ETF flow data offers 3 clean lessons that are worth keeping. First, even the most resilient investment structures have cyclical pauses. Mistaking structural resilience for immunity to short-term volatility is a cognitive trap that costs investors money. Second, thematic ETFs require more active monitoring than broad market funds. When you buy a memory chip ETF or a Bitcoin volatility product, you're making a concentrated sector bet, and that means you need to understand the conditions under which profit-taking will accelerate. Momentum can reverse fast. Third, the ETF industry itself is evolving rapidly. The push into private markets, the RAFI index acquisition, the emergence of volatility-linked crypto products, these are signs of an industry that is expanding its perimeter, and with that expansion comes new complexity. As an investor, staying informed about what your ETF actually holds, how it's constructed, and who benefits when you buy or sell it has never been more important. One rare red week won't define 2026 for ETF investors. But it's a useful reminder that even the best vehicles require the driver to stay alert. So here's where we land on Tuesday, July 14, 2026. ETF flows just posted a rare negative week, driven by profit-taking in thematic plays like memory chip funds, repositioning ahead of potential new products linked to the SpaceX IPO, and a modest macro-driven risk-off move. It is not a structural crisis. It is not a signal to abandon your passive investing strategy. It is, however, a perfectly timed reminder that all markets, even the most systematically driven ones, breathe in and out. The investors who navigate weeks like this most successfully are the ones who understand what they own and why they own it, who distinguish between short-term positioning noise and genuine shifts in fundamentals, and who resist the temptation to react to a single week's data as if it were a verdict on the whole market. Stay diversified, stay informed, and as always, make sure your portfolio reflects your actual investment horizon, not last week's headlines. Thanks for watching.